All right, guys, I'm going to show you the exact process I follow every single week from start to finish of exactly how I run the wheel strategy. So, the first thing I'll do is I'll set up a stock screener. And what this basically does is it filters out stocks that only work for the strategy. There's three main criteria that I like to filter out personally. The first one is going to be the options price itself. So I'm going to go ahead and scroll down here. I do have Robinhood Stock Screener pulled up. You can use any free service as well if you don't have Robinhood or a screener through your broker. FinViz is a good free one you can use. Finviz.com, you can use that one for free. So I'll change share price here. Personally, my portfolio is around $50,000 right now. So I like any position under $5,000. In this case, would be about 10% of my portfolio. So I will choose under $50 here. I'll make sure to save that and I'll name this wheel um, dot dot dot. Okay, cool. So I'll name that wheel dot dot dot. I'll go back here. And that's the first thing I like to change. Share price is very important. You don't want positions over $5,000 per position, right? Next is market cap. I like to change this to at least $1 billion or higher. So I'll go 1 billion to 500 billion plus, save that. That's the second thing I like to do. You want established earnings reports. You want a good track record of the company itself. Next, I like to change the implied volatility level. So this is the how much the stock is projected to move in the next 30 days. I like to change this from 40 to 80%. This gives a good range of collecting premiums on a weekly basis. Here, minimum of 40, so you're able to collect enough premium on the contracts, but you don't want a stock that's too volatile. So a peak of 80% there. I'm going to save that. And then I'm going to make sure that options are available. We do need options available on the stock itself. And options average volume is the last thing that I'll change. Here, I like to make sure this is at least 5,000 contracts per day. You want enough liquidity in the stock itself so you're able to get in and out of your options positions easier. So that is the last thing I'll change. I'll save that. And basically what has populated here on the right is 89 stocks that meet all of that criteria we just set up. So here you'll see SoFi. This is one of my favorite stocks to trade. I made a lot of money trading SoFi over the past few months running the wheel strategy. And I'm going to explain exactly how I run that strategy right after this. So SoFi, we're going to go ahead and start with SoFi here. This is a great example. So here I'm going to pull up SoFi's chart on Yahoo Finance. This is the second step in actually implementing the strategy is pulling up the stock on Yahoo Finance to find the strike price that works. This first step was to find the stock itself. Stocks that work well with this strategy are basically every single stock on this list. I personally have found success with SoFi, so I'm going to show example with this particular stock. So I'm going to go ahead and pull up SoFi on Yahoo Finance. This is a free site you can use. Just go to yahoofinance.com or type in Yahoo Finance in Google, pull it up. You can search the stock by the ticker itself and then go to chart. And I'm going to pull up three main indicators on the chart here to help me pick the strike price. So I'll pull up three main indicators, one being the Bollinger Band, second being the 30-day moving average, and the last one being the RSI. So these are all already pulled up on my graph here. I do have the 6-month chart pulled up here. I'm going to go ahead and zoom in a little bit on these prices on the graph here, just so everyone can see that very clearly. So as you guys can see, the current price of SoFi is $28.15. The stock is down over 6% on the day. This is a great opportunity to sell a put option, and let me explain why. So here, the stock's trading right in the middle of the Bollinger Band. Basically, what this band does is it creates a two standard deviation range, both above the 20-day moving average, which is right here, this middle white line, and below the 20-day moving average. So two standard deviations of data above it, two standard deviations of data below it, and statistically, about 95% of the price movement will stay within these bands, the top band and the bottom band. So the best thing to do for me is to sell a put option and agree to buy shares at a low cost all the way down here at the bottom of the Bollinger Band. As we can see here, the price is $25.69 all the way at the bottom here. So that is the strike price I will target on my cash secured put. That is exactly where I collect the premium is by agreeing to buy shares at that low price. I also like to reference this red line, which is the 30-day moving average, and just make sure the strike price of my cash secured put I'm going to sell that put on is below that value of that 30-day moving average, which it is. Lastly, I like to look at the RSI just for reference. Basically, what the RSI does is it creates a indicator of if the stock is oversold or overbought. Basically, what RSI stands for is relative strength index, and basically, it's a indicator of if the stock is oversold or overbought. The lower it is to this 20 value, the more oversold the stock is. The closer to 80 it is, the more overbought it is. I like to see this on the lower end, closer to that 20 range. Here it's trading right in the middle at around 49. Slightly oversold, but that is fine with me. I'm okay getting in at this lower price of the Bollinger Band, which is around 25.50. So I'm going to go ahead and actually look at the options chain here. This is going to be the third step in my wheel strategy on a weekly basis, right? I'm going to go ahead and go to Robinhood. I'm going to go check out the actual options chain and how much money I can make for actually selling a put at that $25.50 strike price we selected from the graph itself on Yahoo Finance at the lower end of the Bollinger Band. I'm going to go ahead and trade SoFi options. I'm going to make sure that sell put is selected here, and I'm going to choose the $25.50 strike price. I'm going to go out about 8 days. I like to target weekly expiring options. So I'm going to go ahead and scroll down here to the $25.50 strike price here. I'm going to select this position. Just for reference, this is over a 1% return in 8 days. This is collecting $30. You're putting up $2,500 for entering this trade. And the worst that happens is you buy 100 shares of SoFi at this low price. In this case, this would not be a bad thing because then you would be able to do the second part of the strategy. So, one of two things can happen when you enter this position. Either you can be assigned on these shares, meaning the price of SoFi goes below $25.50 on this date of November 14th. That's not a bad thing. It does happen, and you are able to start selling covered calls. So that's scenario one. Scenario two, the stock stays above $25.50 and you're able to collect that $31 of premium you got at the beginning of the trade, and you're able to basically reinvest that money right back into the strategy with another cash secured put, as you will get this $2,550 back in collateral to do the same thing over again. So one of two things can happen. Both of them are great and not bad at all. You're taking ownership of shares at a low cost, scenario one. Scenario two, you're not assigned on your position and you can sell another put option the following week. This is a graph that kind of summarizes what I just explained and how the wheel strategy works on a weekly basis. So, beginning of week one, you sell that put option is exactly what I just showed. And if you are assigned, you start selling covered call options, which basically what a covered call is you're agreeing to sell those shares at a higher price than you entered or the same price you entered, depending on where the stock is trading. And if you are assigned on that cover call, meaning the price is above your cover call strike price at the time of expiration at the end of the second week, you are called away, meaning your stock gets sold. You agree to sell at that price you entered. In this case, it would be either 25.50 or higher with this example. And you can basically restart the position as you get cash back at the end of the trade. So here I'm going to show you example what a covered call would look like on this $25.50 position, which potentially we would be assigned on, right? So if I were to sell a call option for 8 days to expiration, in this case, you would receive around a 0.5% to 1% return on this investment as well, and likely it would be closer to this range here. Obviously, the stock's not trading at 25.5 currently, so it's not going to be an accurate depiction of how much return you would receive, but it would be between 0.5% to 1% of 2,500. In this case, that would be between about $12 and $25 for that second week of premium. Keep in mind, 0.5% to 1% a week is 25 to 50% per year. So yes, this strategy works. And yes, if you are consistent in reinvesting the profit you do make from the strategy, it is incredibly profitable.